There are a ton of ways to invest in real estate, and when people ask me how to start, I think the bigger question should be, what kind of real estate investing do you want to get into? So in today's video, I'm going to do a tier list and rank my favorite real estate investing strategies. And as a disclaimer, all of these are actually viable strategies, and there are people out there making millions of dollars with them. But this tier list is based on my experience and understanding of how each strategy works. I'm going to be breaking down the pros and cons of each of the strategies, and I'm going to show you how they rank against each other. Obviously, this is just my opinion, but if you think I'm not giving a particular strategy a fair chance, let me know down in the comment section. So these are the main real estate investing strategies. We have flipping, wholesaling, land, buy and hold, short-term rental, syndication, multifamily investing, lending, commercial real estate, subject to, and BRRRR. And let's start with flipping. I'm going to put flipping as somewhere in the middle of the pack. Flipping is where you buy a property that is heavily distressed, you put in some work into renovating it, and you sell at a higher price. So obviously the pros of flipping houses is that you're able to buy a property, renovate it, make it look really, really nice, and then sell it for a very high profit. People who are flipping houses, especially in more affluent markets like the Bay Area, can often make over 7 figures a year. In the Bay Area, that's considered to be standard if you're a good flipper. When you're flipping houses, there is inherent risk, right? Like when you're buying a property, you're buying it with the assumption that it only needs a certain amount of money to renovate it. And you're also assuming that you can sell it at a certain price when it's all done. But there are a lot of factors involved with flipping a house. First of all, you don't know the exact condition of the property you buy it until you actually open up the walls and see what's behind it. Sometimes you have to do unexpected repairs, like fixing the foundation or adding in completely new drain lines, or maybe having to redo the HVAC system. So all of these are major costs that you really won't know until you get into the property. Another thing is when you're buying a property, you're assuming you can sell it for a certain ARV or after repair value. But what if the market crashes in that short time frame from when you bought it to when you need to sell it? Another big factor with flipping is most investors are using hard money loans to buy these properties in the first place. And a hard money loan is great, but they are naturally going to be a higher interest rate loan, and they typically only have a 1-year term. So if you're not done in that time, because of delays or maybe you weren't able to sell it in time, then you're going to have to pay these extra costs to keep your loan going. Your hard money lender can just foreclose on you and you lose everything in one shot. So flipping, yeah, you can make a lot of money, you can also lose a lot of money. That's why I put in a solid B tier. So wholesaling as a real estate investing strategy, I would put it actually as an A tier, simply because it is relatively easy for someone who is brand new to the business to get in and start making a good amount of money.
I'm rich.
Now, the thing with wholesaling is it is incredibly sales heavy. So if you want to do wholesaling, get used to picking up the phone, getting rejected a bunch of times, going out and door knocking, or sending out a lot of direct mail. Now, the good thing about wholesaling is your risk is actually relatively low because you're really only spending your time, effort, and marketing costs. When you actually get a property under contract, you don't have to put in that much money to get it under contract because ultimately you're not buying these properties, right? You're just getting them in the contract, maybe give them like $100 for consideration to make the contract legal, and then you go shopping around. Now, some of the downsides to wholesaling is that you are competing with a lot of other people who also think that wholesaling is a great business to start with. So it's a lot of competition here. You don't get to own any of the assets, so any of the appreciation that comes and all the tax benefits that come with real estate don't apply to you here either. And because you are doing this on a very short-term basis, you're going to be taxed at the highest rates. So this is also negative to flipping. You're taxed usually at the highest rates as well. Land is where you just buy land and then you sell it to a developer. Now, the big pro to buying land is that no one really wants land, so you're usually able to get it for a good deal. Most of the people that do land acquisitions as a business are finding people who have inherited land and they're sick of just paying property taxes for a big plot in the middle of nowhere. Ultimately, they can buy land for pennies on the dollar and then sell it to a developer who then makes something amazing. But personally, as an investor, I would not buy land, so I'm gonna put this in the D category. A big problem with land is that you can't finance it either, so this is a very cash-heavy business, and you really are just selling to someone else as a development play. So yeah, I don't think this is a great one to be in. I don't really see people who are making a fortune just owning land over a long period of time. Because again, just by holding land, you're actually losing money because you have to pay property taxes. You can't really rent out just raw land, right? So yeah, I'm not a fan of this one, but again, of course, people are making tons of money through this one. All right, the next one is buy and hold. So this one is the typical buy rental property, rent it out, make passive income, and over time you get all these tax benefits just from holding it. And I would put this on the S tier. I think buy and hold real estate is the best wealth generator of all time. Plus, when you buy and hold properties, these are going to be in the 1 to 4 unit category. You're going to be able to get the best loans on them too. So these are typically going to be 30-year fixed loans, which means that you're getting at the lowest rates and they're fixed for 30 years. So one of your largest expenses is relatively predictable. And then over time, property values increase, your rents increase, and this alone can make you very wealthy and not have to work a full-time job anymore. Whereas these other two, wholesaling and flipping, you still have to work, because once you're done with a big wholesale deal or a big flip, you have to find your next one. And of course, if you guys want to learn more, we have a free masterclass where we talk all about buy and hold properties. You can find it in the link down below. All right, so next is short-term rental. So short-term rental in this regard is just going to be putting your properties up on somewhere like Airbnb or VRBO and then renting it out on a nightly basis. So the biggest benefit to short-term rental over buy and hold is that you do get more cash flow in the short run. Like you can typically get between 2 and 3 times the amount of gross income that you can from a typical buy and hold rental. But there are a lot of drawbacks to short-term rentals as well. That's why I'm going to put it on the A category above wholesaling, because you do have the benefit of actually getting assets from this. Like you're holding onto a property, right? And typically by this strategy, you can buy nicer properties and still have them cash flow. So we're doing this with our Bay Area property as well as some of the properties we have in Dallas. But of course, the downsides to this is that it is very service intensive. So you can have sometimes some really chill guests and sometimes some very, very annoying guests. Also, because of all the turnover with the guests, sometimes your income isn't as consistent. So even though the potential is 2 to 3 times what you can make from buy and hold, that may or may not always be the case depending on if it's vacant or not. And of course, when you have more and more people, there's probably more wear and tear on the short-term rentals. So expect to do a lot of renovations and having a team to make sure that this property is always at its peak condition. Short-term rentals are kind of on like a life support system right now, because there are a lot of cities who are creating city ordinances to ban short-term rentals. So that's something to look at as well. All right, the next one is syndication. So syndication differs from multifamily because this is just you putting in your money so that an operator can then buy a multifamily property. So typically you're putting in $50,000 of your own money and you're going to be getting like a preferred return, maybe 8% of your money. And then there's some waterfall structure. So you do get some tax benefits. You do get some of the profits. Overall though, I put this as a C. Like, I personally don't like it. If I had $50,000, I'd buy another buy and hold rental property. One of the biggest problems with syndication is the chance for failure is higher, I would say, just because you don't know if the operator is good or not. So it's basically all on the operator's reputation. Like if you're giving your money to someone who doesn't know what they're doing and they ruin the project, even if it's an amazing deal on paper, you don't have any control over it because you are a limited partner. You don't have much say in it. Your money is given to someone else and you have to trust that they don't mismanage it or ruin it for you. So yeah, I think that this cash could be used for something else. Now, of course, people are making a lot of money this way, especially if someone who has a lot of net worth and they don't have the time to do any of these other strategies, then sure, yeah, syndication could work for you. All right, the next one is multifamily. So this is actually buying the apartment buildings yourself. So this is either where you're going to be doing syndication to get money to buy your own multifamily properties, or you guys just have enough money to buy it yourself. I would put this in the A category. Like I'm really a fan of owning apartment buildings. And if I could, I probably would buy some. Right now, I just haven't found a deal that's good enough. And when I did find a good deal, the downside to multifamily shows up. So I'll explain that in a little bit. So one of the big downsides to multifamily is financing is a lot tougher here than it is here for buy and hold. Like these are basically the same thing, right? Except you're getting like 30 units here and just one at a time here. But with multifamily properties, because it is considered a commercial real estate asset, you still have to get commercial loans. And commercial loans, instead of just putting 20% down here, you need to put usually 35% down here. And then here you have loans at 30-year fixed rates, right? So you just know 30 years, I'm paying the same amount. Well here, first of all, the amortization, meaning the time that you need to pay off your loan, is usually between 20 and 25 years. So your principal payments are higher on this loan because you're paying it off in 20 years instead of 30 years. And then most of these loans only have 5-year terms. So that means that after 5 years, you have to refinance or get another loan. Like it's very complicated. And if you're in a situation like this where you maybe bought in 2019 where rates were relatively low, and then here in 2024 where rates have spiked and almost doubled in that time, you're gonna be in big trouble because now your mortgage payments are very high. And if you thought of selling at this time, well, anyone else who wants to buy your property also has to get a loan at these higher rates too. So they probably won't buy it for very much. So that's why commercial real estate and multifamily, like, I don't know, I put it lower than buy and hold because financing is such a pain at the scale. But yes, overall, I do like it a lot, but I put it above wholesaling because you get a lot of tax benefits from owning multifamily properties. So next one is lending. So lending means you're a private money lender. You want to give money to like a flipper or a buy and hold investor, and then you get a note. So a note is like a mortgage. You're the bank, right? And there are people who love private money lending because they just give their money to somebody else and they just get their passive income from it. The thing is, I consider this very much like syndication, where you're giving your money to someone and you need to make sure that that other person does their job properly. So I would say this is also a C category. Like the upside is so limited here. You're probably getting between 8 to 12% of your money by lending it out like this, but is it really that worth it? Like I don't see it. Now with lending, again, because you're not actually owning any of the real estate, you don't actually get many of the tax benefits or benefits in general of owning the real estate, right? All you get is your fixed return. So basically it's not a great deal. Like, I don't know, I would stay away from lending unless you have a lot of money and you're not worried about giving it to someone else to play around with, basically. Okay, the next one is commercial real estate. So commercial real estate, I always put it as a D category, simply because of COVID. So commercial real estate, that's like, bigger warehouses or office buildings, strip malls, stuff like that. Now, the reason why it's a D category is, first of all, like, let's be real, most people who can afford this aren't watching this channel. Second of all, commercial real estate has the same problem as multifamily real estate, where you need to put down 35%. These loans are on 20 to 25 year terms. Every 5 years, the rate adjusts, or you have to refinance. So it's really not friendly. You do need a lot of capital to put into this. The returns on commercial real estate also aren't like super amazing. So it could be cool for some people. Again, I think this is really good for people who have a high net worth. They need to blow $100 million somewhere, so you might as well buy some strip malls. But yeah, after COVID, a lot of like other activity places are closing, right? You can see it. Malls are closing down. Strip malls aren't doing as well. You maybe have like one restaurant in the middle of a giant plaza. Everything else is shutting down. So yeah, commercial real estate, I would probably stay away from this at the moment. So let's talk about subject to. So subject to is where you can go to a seller and take on their current mortgage. So let's say that they are selling a property for $500,000, but they already have a mortgage on it for $200,000. And the rate is at 3% because they got their loan a long time ago. You can go in there and potentially take over their current loan at 3% and then buy the rest out. Now, a lot of people are seeing this online and thinking this is a great strategy. And it is if you do it right. The thing is, most people who have loans that are assumable, which means you can take them over, are going to be at a much lower loan amount than your purchase amount. So when you usually buy a property, you're getting a loan for 80% of the purchase price. So if the home is worth $500,000, then you as the buyer would put in $100,000 or 20%. And the bank would lend you the $400,000 or 80%. But if the loan amount is only at $200,000, then you as a buyer have to come up with $300,000 in cash. So yes, maybe you are able to get a property subject to another person's loan at 3%, which sounds great on paper. But if the loan's only $200,000, then you have to come up with a lot more money in cash to buy this property. The whole point is that most people can't even afford loans in the first place. So yeah, subject to, like, it's great when it works, but it's not reliable. That's why I put it as a C category. Like, you really need to dig and find someone who's willing to sell you the property for below market value and then be able to take on their loan subject to, so that the money you actually put out is very, very low relative to the mortgage. Okay, finally, the last one is the BRRRR method. So BRRRR stands for buy, renovate, rent, refinance, then repeat. And this is basically the same as buy and hold, except you're doing the strategy of then taking out your equity again and buying another property. This is an amazing strategy. I do put on the S tier, but I do put it behind buy and hold just because right now the interest rates are very, very high. So the chance of you actually pulling this off successfully is not as high as it used to be. Also, every time you do a refinance, you do have to spend a good amount of money. And every time you try to tap into your equity, you are paying $5,000 or $10,000 worth of closing costs to do this. Again, if interest rates were super low, you are able to find really good deals and then renovate the properties to increase your equity and then refinance to get all your money out, and then the rent still pay for all that. That's like the dream, right? Because you basically have this property giving you infinite returns. But because interest rates are so high right now, this is just not as viable as it used to be. And the thing about BRRRR is this is actually a combination of many different methods, right? Like with BRRRR, you're buying a property basically at wholesale prices, so very, very low equity. And then you're basically flipping it, right, with the renovation, so making it ugly to turning it to really nice to increase the equity. Then you're holding on to it and you're renting it out. But when you're refinancing it, it's kind of like flipping, except you're not really selling it. You're just getting a loan for the money back, and then you're paying that off with the rents that you get. So this is like the ideal strategy for me. It's just that right now, because rates are so high, I'm putting it a little bit lower. So this is my overall tier list. We have buy and hold and BRRRR on the S tier, short-term rental, multifamily, and wholesaling on the A tier, flipping as a B, syndication, lending, and subject to as a C, and then land and commercial real estate as a D. So now that you've seen my list, let me know your thoughts down in the comment section below. And also, now that you've seen what strategies I think are great and which suck, the next thing that you want to see is how I pick which states to invest in right over here. Thanks for watching. I'll see you next time. Take care.